Hello again and welcome back to another session of Commerce class with me, Suman Rathore. Students, insurance involves pooling and dividing of risk over a large group of persons. It is a form of contract under which the insurer insures the life and property of insured in return for a consideration called premium. And as it is a contract, there are certain principles which are needed to be observed by both the parties to ensure the validity of a contract. Like, first is principle of utmost good faith. A contract of insurance is based on good faith and trust, and according to this principle, both the parties, insurer and insured, must disclose all the material information which would influence other parties' decision to enter into a contract, like whether to accept the proposal or to reject it. And if any important information is concealed or misrepresented, then the insurer can reject or cancel the contract and it will become void. For example, if a person suffers from a serious invisible disease but he does not disclose this material information while getting his life insured and later on the person dies due to that disease, then the insurance company can refuse to pay the compensation to his legal representatives as the material information was not disclosed at the time of taking the insurance. Next is principle of insurable interest. Now this is one of the most important principle of insurance, and according to this principle, the insured must have pecuniary interest or financial stake in the subject matter of insurance. He must benefit from its existence and lose from its destruction. For example, a person has insurable interest in the life of his partner or in his own life, but he has no insurable interest in the life of a stranger. Now, this insurable interest must be present in case of fire insurance. It should exist both at the time of contract and at the time of loss of the subject matter. And in case of life insurance, insurable interest must exist when the life policy is taken. And in all the other types of insurances, it must be present at the time of loss of the subject matter. Next is principle of indemnity. Now the principle of indemnity states that the insured can get only the compensation for the actual loss suffered by him, and he cannot make a profit out of the happening of the loss or the damage insured against. The main object of this principle is to place the insured person in the same position where he would have been if he had not suffered loss due to the risk. For example, if a policy to insure goods against fire is taken for rupees 10 lakhs and goods costing rupees 7 lakhs are damaged, then insured will get rupees 7 lakhs only. But in case goods worth rupees 12 lakhs are damaged in fire, then insured will get the compensation for rupees 10 lakhs, that is the policy amount. Next is principle of subrogation. Now principle of subrogation is corollary to the principle of indemnity. According to this principle, after the insured gets compensation for the loss or damage to the property insured by him, he loses all the rights of ownership. And now the insurer steps into his shoes and acquires all the rights and remedies of the insured. For example, suppose a house is insured for rupees 5 lakhs against fire. The house is damaged by fire and the insurer pays the value of rupees 5 lakh to the insured. Later, the damaged house is sold for rupees 2 lakhs. Now, the insurer is entitled to receive the sum of rupees 2 lakhs, not the insured. Next is principle of contribution. Now, this principle is applied when the subject matter is insured with more than one insurer. In such a case, insurer can ask the other insurers to contribute their share of compensation, and if the insured claims full amount from one insurer, then he loses his right to claim any amount from other insurers. For example, a person gets his house insured against fire for Rs 5 lakhs with insurer A and Rs 3 lakhs with insurer B. Now, if the fire happens, then A and B will contribute to the total loss in the ratio of 5:3. Next is principle of causa proxima. Now this is also called the principle of nearest cause. A loss may arise due to so many causes. The insurance company will find the nearest cause of loss to the property, and if the proximate cause is insured, then only the insurer is liable to pay the compensation. Otherwise not. For example, suppose a person has taken personal accident insurance policy and he met an accident and suffered various injuries. Now he has been admitted to hospital for treatment where he contracts an infectious disease due to which he dies. Now the cause of his death was an infectious disease and not the injuries of the accident. As such, no compensation will be paid to him or his legal representatives. Next is principle of mitigation of loss. Now, according to this principle, in the event of a mishap, the insured must take all possible steps to mitigate or minimize the loss to the subject matter of insurance. He should act in the same manner in which he would have acted in the absence of the insurance contract. For example, if a person has got his factory insured and it catches fire due to a short circuit, then the insured must take all necessary steps to extinguish the fire to minimize the loss or damage. He must behave in a manner as he would have in case the factory would not have been insured. As such, principles of insurance are actually the guidelines which are needed to be followed by both the parties so that they can avail the benefits of insurance facility. That's all for today. Thanks for staying in tune and don't forget to like and subscribe my channel. Thank you and goodbye for now.